Well, today the Reserve Bank board met, as it always does on Melbourne Cup Day, and historically that is one of the most frequent days for changes in monetary policy, but not today. I'm joined by my fellow independent economist, Stephen Halmarick, formerly Chief Economist of the Commonwealth Bank of Australia, and now running his own business, Unchained Economics, and is also part of the InEconomics group. Stephen, welcome. First of all, the decision itself was no surprise to anyone, was it?
No, that's right. After last week's third quarter inflation reading, which, as we all know, is certainly much higher than expected, the rates on hold decision today was pretty straightforward. Indeed, it was a unanimous decision by the board, and I don't think there was one economist forecasting a rate change today. So, very much as expected.
Right. So let's look at that inflation outcome that was so critical to the shift in the markets and economists and presumably the Reserve Bank's thinking itself. Most economists, I think, going into last week were expecting a 0.7 or a 0.8% increase in the trimmed mean measure of underlying inflation that the Reserve Bank sets most store by. The Reserve Bank itself, I understand, was expecting a 0.6 increase. Governor Michelle Bullock said at the beginning of last week that a 0.9 would be a material miss, and we got a 1. What did we and the Reserve Bank get wrong in that figure?
Yes, as you say, 1% for the quarter, well above expectations, including the RBA's. I was at that dinner that the Reserve Bank Governor spoke at last Monday in Sydney, Australian Business Economists annual dinner. And when she was asked that question, what's a material miss? She said, 0.3% more than the forecast. So given their forecast was 0.6, that's a 50% error. And it was even higher than that at 1%. So there was a couple of things. One was just some timing factors around the electricity rebates, which are a bit hard to kind of get a handle on. But as the governor pointed out today, and again, many economists, including us, pointed out last week, there were some factors in that CPI number that really show a bit more entrenched inflation, particularly in the housing sector and also in some market services. So things like holidays, both domestic and international, eating out, things like that. So as the governor mentioned in her press conference today, it looks like there's more spare capacity in the economy than they thought. And things are a bit tight. Looks like there's less spare capacity in the economy than they thought. Things are a bit tighter than they expected, and more inflation broadly. So they've had to make some pretty significant changes to their inflation forecasts, at least in the near term, over the next 6 months or so, before they get back to close in the middle of the target range in 2027.
I'll come back to the forecasts in a minute, but just wanted to drill a little bit more into that September quarter outcome because it was so crucial to today's meeting. Is it possible, as some have suggested, that the pickup in household spending, which the Reserve Bank had forecast but noted may have been a bit stronger than they had been expecting, has given businesses more room to pass on to customers in the form of higher prices cost increases that they've been experiencing, including significantly, despite the slowdown in wages growth because of poor productivity, big ongoing increases in unit labour costs?
Yes, I think that is definitely possible. Businesses might have been holding back on putting some prices up because the economy has been pretty soft, and they saw a bit of a pickup in consumer spending through the middle part of the year. There was a few, big one-off events that got some spending going, but generally real wages were rising for the first time in a number of years. Real household disposable income rising for the first time in a number of years. So definitely possible that businesses said, we've got an opportunity here to pass on some of those higher costs that they've been experiencing over the last few years. And that's shown up in the CPI data last week. So I definitely think the Reserve Bank governor and the board are a bit worried about that. The jury's still out, if I can put it that way. They're not quite sure how that's going to pan out. The governor said that there's some temporary effects in the CPI, but there's probably some more persistent inflation there as well. And that's going to, I think, on my forecast, take at least, another 2 quarters worth of inflation data. So the full December quarter of this year and then the March quarter of next year, and we'll get those monthly readings before the Reserve Bank really has a better handle on whether it's just like a temporary reacceleration in inflation or something a little bit more nasty.
The other significant contributor to the pickup in inflation in the September quarter, which the Reserve Bank again noted in the statement on monetary policy was in new housing costs. Rent inflation has continued to recede, but there was a big pickup in new housing costs, which perhaps was a byproduct of the increased demand for housing, triggered in part by the three reductions in interest rates we've already seen this year. Is it also possible that perversely the cuts in interest rates that the Reserve Bank has instituted in the first 3 quarters of this year have contributed to a revival in housing price inflation that's in turn complicated the task that they now have?
Yes, I think that's definitely a factor. We saw after the 3 rate cuts we've had this year, February, May, August, house price growth has accelerated. The data from Cotality for September, for October, which came out just yesterday, showed the biggest monthly increase in prices for a number of years and some real strength across the country in house prices. And particularly we've seen a big increase in costs for dwellings, particularly for apartments. And from the people I speak to in the construction sector, the increase in cost of building apartments has really outstripped the willingness, or the price that people are willing to pay for those apartments. But now that might be catching up a bit. So again, construction companies may be feeling a little bit more confident that they can pass on the extra costs of construction, given there's some more demand.
And there's certainly plenty of anecdotal evidence, so not too much hard data, apart from those Cotality figures that you mentioned, that the government's 5% deposit scheme could also be further adding to demand, at least for properties perhaps in the bottom 2 quartiles of the distribution of prices. And I think the Cotality data did say there were bigger increases there than in the upper end of the market.
Yes, I think the evidence so far, we've only had a few months, that the extra demand created by the 5% deposit scheme for first home buyers is definitely a factor in there, pushing prices up. So again, bottom line is, Saul, as we all know, when the demand exceeds supply, there's only one thing that can happen to the prices, and we've got a number of factors pushing up demand for housing in an environment where the amount of new supply coming on just is well below the level required to meet that demand.
So the Reserve Bank's revised forecasts have got the annual underlying inflation rate at 3.2% by the June quarter of next year. Does that make it impossible for them to cut rates even at the meeting in May? Or would it be sufficient for the quarterly inflation numbers for the December and March quarter to be low enough for them to look through that annual inflation rate and cut rates if they're sufficiently low?
Yeah, that would be my feeling, is that by the time we get to May next year, bearing in mind, again, we'll be looking at the monthly headline as well as the RBA is going to keep looking at the seasonally adjusted trim mean quarterly, that those monthly readings or the quarterly trim mean will be coming down a bit and allow them to cut rates in May next year. I think particularly if there's some softness in the labour market, if the unemployment rate is higher than their current 4.4% forecast for every quarter all the way out to the end of 2027. Importantly, I think the governor repeated a couple of times in the press conference that the higher than expected September quarter number, stays in the annual calculation for a year. So, by the time we get to May next year, what happened in September this year is not really reflecting the current environment. So I think it will be up to the monthly prints and the quarterly trim mean rate to determine that May 2026 rate cut.
So if they're to see their way clear to cut the cash rate in, let's say, May, they probably want the quarterly underlying inflation numbers to be something in the range of 0.6 and 0.7, or the monthly numbers to be something around 0.2, wouldn't they?
Yeah, I think that's right. So, we had a series of numbers earlier this year where we were getting quarterly inflation closer to, 0.6, 0.7. Then, as we've said, we had that big jump up to 1% in the September quarter. So we need to be back to numbers that annualize around the middle of the target range. So that's 0.6 and a bit to get a rate cut again in May next year. or at all next year.
But at the same time, you mentioned the possibility of a further softening in the labour market. And I think it was notable that even though the unemployment rate jumped up to 4.5% in September, and as the governor and others have mentioned, these monthly numbers can be very volatile, but there's been noticeable upward trend in the unemployment rate over the first 9 months of this year. And yet the Reserve Bank is expecting the unemployment rate to remain essentially constant at 4.4% all the way through to the end of 2027. What do you think the risks are to that forecast?
Well, I think the risk that it's going to be higher than the 4.4. And I think if you look at all the new forecasts that came out today, the unemployment rate forecast is the one where I think that there's the biggest chance of a miss on their forecast. They've got inflation pretty high in the near term and then slowly getting back to target. They've got inflation around about 2% annual rate all the way out to the end of 2027. They both seem pretty fair. But they're forecasting the unemployment rate at 4.4% every period out to the end of 2027. It's currently 4.5. So even though there is a lot of volatility in that monthly data, I think given interest rates now are unlikely to fall as far as people thought they would, as little as 2 or 3 months ago, we might get some more softness in the economy. We might get some slowdown in the pace of government-funded employment growth, both at the federal and state level. And so I think the risk to the unemployment rate forecast is that the unemployment rate ends up being a bit higher than the RBA is expecting. So that'll work in the opposite direction to the inflation forecast changes, and might just have the RBA board thinking a little bit more about rate cuts as we get through the first few months of next year.
Now, of course, the other thing that has been a contributor to the persistence of inflation, especially for services, has been continued strong growth in unit labour costs. Even though wages growth has slowed, productivity growth has been so poor that unit labour costs have been running at close to 5% per annum, I think, of late. Do you think it's becoming more important in the Reserve Bank's thinking about the amount of spare capacity that there might be in the economy, that the speed limit on non-inflationary growth is lower than they had previously thought?
Yes, I'm certainly thinking that's something that they're worried about. They have pointed to those unit labour cost numbers pretty consistently over the last few years as one of the factors limiting rate cuts. Again, the governor highlighted today that the Reserve Bank didn't take interest rates as high as other countries. That means this rate cutting cycle can be pretty shallow. It may only be 3 rate cuts that we've got, and maybe another one early next year. That's pretty limited compared to what other countries have done. And most of those other countries have had to cut rates further because they've had significantly more weakness in the labour market, which to date we haven't seen. And those unit labour costs increases because of the very poor productivity effort by the economy. Looks like they're embedded in the forecasts for at least the next couple of years.
The other thing I thought was interesting in the detailed statement of monetary policy was the suggestion they made in a couple of places that the cash rate of 3.6% could be closer to being neutral.
Yeah.
That is neither stimulating or restraining economic growth than they had previously indicated. Their models that they publish in chart form appear to suggest that the neutral rate is less than 3% on most models, and their rhetoric had seemed to suggest they thought it was somewhere between 2.75% and 3.25%, which is what I think most economists would have. But they seem to be suggesting that it's actually not that far below the current level of 3.6%. Were you surprised by that, or is that in line with what your thinking has been anyway?
No, my thinking has been more in line with what the Reserve Bank had been saying in the speech given by Chris Kent from the Reserve Bank a couple of weeks ago, which I thought pretty clearly showed that they thought the neutral rate was about 3%, which would imply 2 more rate cuts from here, 3.6 down to 3.1. And that's what I thought the neutral rate was, about 3. But Michelle Bullock was asked about that today, and she said, well, we're closer to the neutral than we thought we were. And, neutral's this kind of like this nebulous concept. We don't really know where it is. And she also said it's harder to know where it is the closer you get to it. So she then went on to say, well, basically the Monetary Policy Board's just going to take this meeting by meeting, and we'll let the data tell us whether we're already at neutral or it's a little bit lower than where we currently are. And as we've been saying, given the inflation reading, I think it's going to take at least another 6 months. So that's 4 more Monetary Policy Board meetings before they've got some confidence that actually the neutral rate's probably a bit lower than where they are today, and we can get the cash rate closer to it.
That almost sounds a bit risky, given the lags between what's happening in the real economy and what the data tells us when it comes out, and the lags that are well understood by economists, even if they're hard to be precise about, between changes in monetary policy and the impact they ultimately have on economic activity, is by saying that they don't want to make a judgment about where the neutral rate is, but instead hoping that the data will tell them where it is when they hit it. Are they increasing the risk that they might err on one side or the other in setting monetary policy?
Yes, I think they are. And you can see the governor's very reluctant to give, any type of forward guidance. It's always meeting by meeting and let's see the data. But I think the bottom line is that the inflation number that we got last week has really spooked them quite a bit, which is fair enough given how high it was relative to forecast. So I think, what they had laid out in August, which was an assumption embedded in the forecast of 2 more rate cuts, inflation trending back to the target range in a pretty decent time, the labour market remaining relatively tight. The inflation number that we got last week has kind of blown those forecasts out of the water. And so we've got higher near-term inflation, a tick up in the unemployment rate, slower GDP growth. It all looks a little bit more, kind of like white knuckle forecast based on only 1 more rate cut in the middle of next year. So I think that number was high enough that they basically say, okay, we're just going to have to step back now and take at least, I think, a good 6 months to really figure out where we're going here.
Okay. Which leads me to conclude by putting to you 2 alternative questions or scenarios. One is the possibility that, as you alluded to, unemployment could end up being higher than the Reserve Bank's forecast of 4.4% over the next 2 years, whilst inflation remains at or above their target. Would it be fair, as some people have, to apply the term stagflation to that combination? And if so, what would the appropriate response of monetary policy in your view be?
Well, I don't think it's fair to apply that stagflation term because, as you and I know, we've been around a while, right? And if inflation's going to be, let's say, 3.25 instead of 3, and the unemployment rate's going to be 5 instead of 4.5, they're not really, big differences.
Well, it's not 10% on both like we had in the early 80s.
Exactly, right? So we're not talking about double-digit inflation and double-digit unemployment rate, right? We're 3 and a bit rather than, 2.5 of the inflation rate and let's say 5 rather than 4.5 the unemployment rate. In the grand scheme of things, they're still not terrible outcomes. So I wouldn't say stagflation, but it's also not a combination the RBA would want, right? It's not meeting their objectives. So the objective is right. 2.5 inflation and full employment that's consistent with that, which is probably around where it is today. So if they're not meeting their objective, that means they've got more work to do on policy.
Well, the other scenario I'd put to you and ask what you think is one which some of our colleagues in the economic fraternity are embracing, which is that the next move in official interest rates, although it might not be anytime soon, will be upwards, that there will be no more rate cuts and that eventually at some point the next move on the part of the Reserve Bank will be to lift rates. What's your reaction to that suggestion?
Yeah, I think it's a bit too early to call that. So that's why I've kept 1 more rate cut in my forecast. Mm-hmm. There's certainly a lot of economists saying this rate cutting cycle is over. But as you and I both know, markets always very reluctant to price in no change for an extended period. So they're kind of like, if they're not going down, they must be going up. But I think given the GDP growth profile is just 2% and the forecasts are still for inflation to be back in under 3 or next year, I don't think that's an environment where we need to tighten monetary policy. And I think we're continuing to get rate cuts in other jurisdictions around the world. I think there's still a whole lot of uncertainty globally about where the economy is going. And then that environment, back to the kind of the neutral monetary policy debate, I think the RBA here should be having our cash rate pretty close to neutral. And I think it's still a little bit above that level.
Well, it is interesting, I suppose, that we've seen in the past couple of weeks both the US Federal Reserve and the Bank of Canada cutting rates, even though, like us in Australia, inflation has been on the high side of their own and market expectations. I guess the difference is that, especially in Canada, but to some extent in the US, the labour market has been weaker than expected. Is that something that the Reserve Bank should be paying heed to here when they're making judgments about Australia?
Yeah, I always think that, the Reserve Bank doesn't follow what other central banks do, including the Fed. But when central banks like the Fed and Bank of Canada are cutting rates, and inflation in the US is 3%, so not much different to ours. There's definitely information content in that. So why is the Fed cutting rates? And I think definitely it's concern about the labour market, and certainly in Canada that's the case, as well as our friends over in New Zealand. Yeah, for sure, in New Zealand. So there's information content, I think, in there that even with inflation higher than most of those central banks are targeting, concerns about the labour market are driving some of their behaviours. So as going back to what we were talking about before, I think that's where the risk is on the RBA, that they're not yet forecasting the unemployment rate to rise, or they're not forecasting the unemployment rate to rise. That's where the risk on their forecast is, I think.
All right. So after today's decision, it looks as though there's not going to be any action on the monetary policy front in February, and that we'll have to hope for a slowdown in the quarterly or monthly pace of inflation in the first half of next year for there to be any chance of a rate cut in May.
Yes, I think that's right. So, there's one more meeting this year that'll pass with pretty much not much fanfare, I would imagine. And then we get the summer break, and then early February next year. And by then we've got a few of the new monthly CPIs under our belt. So that'll be good information content. Another meeting in March, but I think it's the May meeting next year before there's going to be enough data on the inflation rate and the labour market to prompt the RBA to cut rates again.
All right. Well, Stephen, thank you very much for sharing your thoughts with all of that. Let's hope these forecasts turn out to be more accurate than our most recent ones about inflation. And we'll no doubt be back, maybe not after the December meeting, but certainly around the time of the February one, to have a look and see how things are turning out. But thank you very much for talking with InEconomics this evening.
My pleasure. Thanks, Saul.